For TraderInsight.com, I'm Adrian Manz, and it's time for another strategy session. Let's take a look at a first-hour trade. Everybody loves the first-hour trades. This is a Baltimore chop setup or a 2-standard deviation gap setup. Of course, we are not using the usual bands that people use for 2-standard deviations. We are using a volatility-based measure of what is a skewed distribution. So let's have a look at what came up. This is the TradeStation output for Friday, July 3rd, 2014. We see we've got PCAR, Pacar Incorporated, and we've got PETM, PetSmart. As you know, if you were in the war room today, we wound up passing on PCAR, and we wound up taking a trade in PetSmart. So let's have a look at the intraday charts, talk about why we did what we did, and also talk about how to handle the volatility. First one that popped up on our screen was PCAR, and when we looked at this stock in the morning, we saw a couple things that turned us off to it. Julie and I decided not to call this one in the room. We did not take this trade ourselves. You see this opening price here. This would be the first place that we looked for a reversal. But over the course of this first 5-minute bar, nothing happened. When we got into the second bar, we would have looked at this as the deepest bar in the pullback and looked at that level as an entry. But look what happened. We had a lot of buy-side volume on the first bar of trading, a lot of buy-side volume on the second bar of trading. We chose instead, as this thing kept rising, to focus on the second trade, which was PetSmart. Here is the 5-minute chart of PetSmart. We see that it opened, started selling off immediately. Those were really good signs. Now, as you know, sometimes what can go wrong will go wrong, and don't feel like you're the only one this happens to. Happens to all of us sometimes in trading. We were looking at an entry price on this one that reversed the opening price, 68.60. We saw an immediate sell-off occur in this stock. It got hit with very heavy sell-side volume. It moved lower, moved higher, and when it came back into 68.60, we decided it was time to take an entry. As it crossed below 68.60, now all of you who were in the war room saw this happen real time, I put out a marketable limit order. Marketable limit order means I'll take this entry anywhere from 68.60 down to some other price, right? And in my case, I took and marked the absolute worst price I would take down at 68.11. So unfortunately, I didn't get filled at 68.60. I got filled on this wild spread that we had on PETM where it was just really moving rapidly higher and lower. Spreads were about a nickel, but the movement in the stock was as volatile as anything I've seen in the last 3 or 4 years. So we got filled all the way down at what was considered our worst acceptable entry price and then had to ride out a 55-cent reversal against us before we wound up getting down into the area that we had targeted as a profit target. So a couple of you in the room were questioning why I wasn't taking this trade-off because I had an open loss on it as it was traveling higher from my entry point. And the reason that I gave you is my stop loss was up above the high of the bar. My reason for entering this position in PetSmart was because it violated this opening price. The excursion from that opening price to my stop loss was not that much, right? So I only had about a 40-cent stop on this one, and I had a pretty wide target. So why not take the trade-off early when you've lost as much money on something as you're really willing to lose? And you guys have all heard me say this a million times. The market does not care how much you are willing to lose or how much you want to make. It's all about support and resistance. And resistance this morning was very clearly up at this high of the first bar of trading. There was no reason to take this trade off as it reversed. Julie and I were looking at each other saying, holy cow, you know, what's going to happen with this one? Doesn't matter. It came back down again. Got back through our logical entry price, got back down through our actual entry price, and began an extension. We saw price bump off this 63.34 level a couple times, and we wound up taking the trade off on a move up through 67.50 that actually wound up clearing us out at 67.72. So once again, not a great exit, right? We were hip deep in volatility. Much, much more volatile than these things usually are. And I put out an order that was once again a marketable limit order, and I was trying to get out at 67.50, and I wound up getting out right around 67.70 or 67.72. So it was a profitable trade. It was upside down, meaning that I had a bigger open loss than what I was expecting in terms of a profit, but all that's okay, because even if you mess up an entry, the most important thing is that you take the rest of your trading parameters, the rest of the rules by which you were going to govern that trade, and stick to them, even if that means having an uncomfortable stop. Because artificially moving the stop down to, let's say, here, would have resulted in us taking a 50-cent per share loss, and that's $500 on 1,000 shares. And when it moved back down into our profit target, the only thing we could have said to ourselves is, why did I do that? That has nothing to do with where I was expecting price to inflect. So there you have it. That's PetSmart Incorporated, ticker symbol PETM. A little bit of a rough trade, but it teaches us something about following the rules. Right? You break the rules, you go back to school. You trade by the rules, you know what you did, you know why you did it, and you know why everything turned out the way that it did. For TraderInsight.com, I'm Adrian Manz. I hope you had a great trading day on Friday. Have a great 4th of July weekend. Have a fantastic trading day on Monday. Best trader education anywhere, only from TraderInsight.com.